All right, well, good morning and happy Saturday, active traders. I wanted to wish you the best for a peaceful Labor Day weekend. I'm Ken Calhoun, president of Day Trading University, Trade Mastery, and many other sites serving thousands of the world's traders since the year 1999. We're celebrating our 21st year in business. If I were my company, if I were a TV series, we'd be celebrating our 21st season. So been around for a long time, trusted by people because hopefully I help people accomplish their goals. In today's session, again, all information is for educational use only. In today's session, I'm going to cover what's going on in the market and what we can, kind of a thoughtful process for how to prepare for next week's moves. So the S&P has been choppy as heck throughout August, right? It's been a directionless market in August that's very likely to break out starting next week. This is a market in which we have consistent bull traps, right? Just like the market broke over 3,000, and I was telling everybody, bull trap, gang, it's going to be a BS breakout, it's going to fake out, and I was right, it capitulated and dropped. We've seen this intraday often, well, like yesterday, right? Our S&P gapped up, gap, and roll down, or gap sell-off. So it's a bull trapper's market. So don't buy breakouts in our current market. This is not a brand, unless you're trading gold. But virtually everything else has been either pivot trading or very careful trade management designed to keep you out of trouble and in on the biggest winning trades possible. Anyway, it's a fake out market. So my point is, if next week the 50 SMA is right near the 29.48, so if we break north of that near 29.55 or so, that'll get people in. Don't buy, don't believe it. It's likely to be a fake out versus the breakout. We're likely to see the breakout and people say, oh, we're back in long market. Just like people, how soon they forget. How many people forget? Last time we broke above the 3,000 key resistance, we got a big epic sell-off. Bearish engulfing right here, right? And I told everybody that was going to happen. I expect that to occur again. Again, we don't predict, we react. I'm just curious, how many of you type in the word bull or bear? I'm a bear. I could be wrong. I've been wrong before. And dust myself off, take small stops, and climb back out of it, do my trade repair work, and get myself back in the money. But how many of you are bullish? How many of you are bearish, say for the month of September? If you had to guess, what do you think? What would you, we don't predict, we react. I get it. But still, do you think the market's going up or down? What do you think? I'd love to hear from you guys. Reluctant bull, bear, 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 bear now, bear, bearish for sure. Bull last quarter of the year. Yeah, Mura, typically you're right. Window dressing. We will have some buyers. Bull, bull, reluctant bull, day by day, bull down, bear, bear. September is historically a bear month. That's correct, Bill. August and September have often been sell-off markets. Yeah, I think Mura, my trader Mura is right. We may well get a breakout into year's end. So I would not be overly bearish in November, December. We may well, especially December is usually Santa Claus rally, but not last year, right? We had a big sell-off into the end of year. Anyway, right now, and the price that proves bears wrong on this chart, R1 is the 50 SMA. More important, strategic R2 would be up at the 30-30, right above new highs. So first up here in this region, and then up here would tell us that we've got buyers back in town. My expectation, and I've been right so many times, they call me the, was it a guy called me a NASDAQ Nostradamus, one of my traders, Joe, from one of my live seminars. And if you're out there, Joe, thanks. NASDAQ Nostradamus. I like that. He called me that like 8 years ago. So thank you. I appreciate that. I'm pretty good at forecasting because my money's on the line and I'm training tens of thousands of traders. So hopefully we keep things on the right side. Expect false breakouts 100% for the rest of the year. Expect every time you see a new high, don't get excited about buying the new high. Say, nah, pass. Like I told you guys last in July, the first breakout I said fake out, and I was right. Second breakout I said fake out again, and I was right. Now we're kind of in consolidation. A bullish sign, and a CNBC commentator correctly got it right, that we do have a connect the dots, uptrending lows which is bullish net, right? And kind of ascending bottoms in the S&P. Major supports here at the 2810. So we may well cycle around in here, but if we lose the 2800, watch out below. So do be on the radar for that. The instruments that have done best in this sideways consolidating market, which is a bearish lead indicator. Any professional trader will tell you this. If the institutional folks have been loading up on gold, which they have the last couple of months, that is bearish for the stock market. Gold and defensive stocks like healthcare and utilities tend to be defensive plays in the market. So that's why we're seeing upticks in stocks in those sectors, but mainly gold. So gold's a defensive hedge. And so when gold goes up, that's a lead indicator that trouble's on the horizon for the stock market. Just like when TVIX spikes up. Come on, TVIX. Like I was trading it quite successfully yesterday, and I told my members in the live trading room back here, long before the opening bell, I said we go long if it gets over 1725 and again over 1760. A big swoop up in volatility, or if you just look at your VIX, you'll see the same chart pattern, or UVXY or VXX, or any of the inverses. That's a kind of a quick market snap, right? So that may lead to weakness in the market moving forward. So my point is, the defensive plays in our current market would be to go long in the inverse ETFs like SQQQ I like a lot as well, because it's got so much upside potential. All these inverses that have been dropping during the bull market are very likely to continue up. This was last December, right? Last end of the year, the market sold off, and then the day after Christmas, the market came back and it rallied to the upside, right? It rallied to the upside day after Christmas. So anyway, with that kind of volatility, you've really got to get good directional guidance or get a good handle on where the money's at. Where's the most likely plays going to run? You know, for example, I was looking at this here. I was doing a lot of trading yesterday. I bought a little bit of the pot stocks, very conservative, just a few $100s worth. So I bought $350 worth of CGC, $300 worth of Kronos, a little bit of DWT, partridge in a pear tree. Here's an example of the type of stops that I take on day trades. I took a stop loss yesterday in Big Lots, BIG. I take stops every single day, and I'm dang proud of them because they're so small. Any good trader, it is completely irresponsible for any educator to advocate large stop losses like some of these moron kids in chat rooms saying, I had a minus $3,000 day. Why would you ever learn from some moron like that? My stop loss is $4 on this trade, right? And often, you can go through my history and see most of my stop losses are under 30 bucks. The vast majority of them. Even the big stops maybe $60, $70, and that's extremely rare. For intraday trades, trading 100 or 200 shares, very small size, stop loss cost of $10 or $20 is great. And if that appeals to you, then do be sure to join. That's called the turn in sales. You correctly segue into it. That's if you're interested in learning how to take itty bitty stops when you're wrong, which should be job number one for every trader in the world. I'm a total stone cold expert at it. I've traded millions and millions and millions of dollars worth of stocks and ETFs with tax return proof. All right. You've probably seen it. If you want to learn how to keep really tight stops, you want to learn with me in the live room. And of course, all the winning trade alerts is icing on the cake. But the main thing that I'm proud of is that I teach my traders how to keep really tight stops when they're wrong. And also combine that with the strongest charts, like TVIX yesterday. We got such a big group now. I have so many new traders in. We're record high new subscribers in my live room because people get fed up with the small cap, gap and crap, BS, stupid stocks. We like stocks like this, like Micron, TVIX, Target, Kohl's. They're not expensive, Nordstrom's, SQQQ. But neither are they cheap $2 and $3 stocks either, because those are horrible. They're okay for swing trading, especially small cap gold. But anyway, you can go to 3winningmonths.com and join now. Hey, another quick freebie. Or I should say, a quick freebie. I'm starting to work on a free day trading course for all of you. I did the first video, how to set up your charts. It's at my old Day Trading University site, daytradinguniversity.com/day-trading-course. What's a topic that y'all would like to see beyond all these? Is there a topic you'd like to see me record? I'm going to record maybe a dozen or so, 8 or 10, maybe 15-minute videos. Not basic 101 stuff, but kind of intermediate level professional day trading strategy tips. So everything from entries and exits to trade management to developing a sensible, easy to understand chart setup using any charting software. But that's something that I'm working on. Oh, thanks, everyone. Oh, thanks, Mukesh. Appreciate it. Right, Bill. Blender markets are tough. Hey, Ahmed, what's the inverse ETF of S&P 500? SPXS. I know this because I trade this stuff. SPXL is a long, SPXS is a short. I'm not in love with either one because they don't have as much volatility as SQQQ versus TQQQ. Or TVIX versus SVXY, or VXX versus SVXY, whatever. But anyway, free course on the way finally. So anyway, lots of new content. And that's mostly for social. So what else do we have? We got a few minutes left here. One thing you want to pay attention to, not only small cap gold instruments, which have been especially strong lately, but outlier charts that have good relative strength. Now, if you trade stocks like this, who can tell me what's that technical buy signal? It's always good, I think, to do. I'm a big fan of candlestick charts, as taught by my colleague Steve Nissen. We worked together 17 years now, a long time, a great guy. But anyway, what are those patterns? We've got one hammer, but in this market, I mean, a single hammer is good, but what's better than a single hammer? Like Thor. There's got to be a joke in there somewhere. What's the name of the Thor mithril or something, the hammer? I didn't like the latest Avengers Endgame. The big battle scene at the end was good, but the rest of the movie wasn't any good. The Aladdin new movie is good, though Jafar and Jasmine weren't any good. Will Smith crushed it. He was great, and the Aladdin character is okay. John Wick 3, outstanding movie. I digress. Anyway, it's double hammer time, right? We got a hammer in each hand. Boom, 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 boom. Like the taiko drums. So we got tweezer bottom, double hammer. That's good. One pattern that I teach in the live room and in swing scans is look for the small followed by a large whole row body momentum candle pattern, and buying on this price instrument maybe 50 cents above the high would have been great. Now we got some. So, okay, the hammers would have got you in. What's this chart pattern, though? What's this chart pattern? I always like to do a little training and education to help you decide to develop better trading skills, both your pattern recognition and your trade management skills, so you can intelligently put on a better winning approach to trades, right? You're looking at putting together a portfolio of stocks, maybe 8 or 10, no more than a dozen or so for swing trades. For intraday trading, you may trade 2 or 3 instruments each morning, either 1 or 2 trades or, like me, mini trades. Anyway, that's a bearish engulfing. Now, what confirms the bearish engulfing? In this market, the point is not just the simple candlestick chart analysis. Double confirmations in a choppy market. That's the bit of wisdom here I'll share with you right before we wrap up. I've got a few minutes left. Double confirmations. Volume is really important. If you see it, I don't see any significant volume signals in this chart here, but double confirmations. So not just 1, but 2 hammers. If 1 is good, 2 is better, right? And here we have a bearish engulfing, right? But here we also have kind of a shooting star pattern. So that's a double sell signal. We had a double buy signal here, a double sell signal here, right? So be on the lookout. My point is, give preference to those charts that give you multiple technical confirmations, particularly valuable in a sideways market, right? I remember fondly back when I used to do these the Traders Expos, and as a featured speaker, uh, I like Larry, I like Rob. I don't know Dan, but I know he's got a good reputation. But anyway, if you've seen me speak live from New York, it's King Calhoun at the Marriott Marquis in Times Square. That was fun. They had a full house. They had to turn people away. The people standing in the back, over 150 people, I think, paid, happily paid for 4 hours of my time. Paid money show, 329 bucks, and I got a standing O and all the claps, and people wanting to do selfies with me after. And this was a couple years ago. Anyway, for even less than this, you can get 30 to 40 hours of training with me in my live room. So I don't get out much anymore. I'm a busy guy, so I don't have time to travel. And also, the older I get, the more I got health issues, and it's hard for me to have the energy and I don't know if anyone else is like that, but once you get over 50, you kind of slow down a little bit. So I used to travel the world as a top quality management consultant for big companies all over the place, right? In Asia, Europe, throughout America. But the older you get, the less you like living out of the suitcase, and the more you like serving all of you, right? A big epic turnout, and I can leverage. So anyway, in our current markets, and thanks to all of you for showing up. In our current markets, look for double signals, and they're out there, but you have to know where to look. And that's really important to avoid or minimize the potential stop outs or shakeouts in a chop market, right? Last but not least, let's cover our cannabis sector. Like I said, I bought a little cron yesterday. I think it was after the market closed. It was after the market closed. I went shopping for stocks. And by the way, you got like 4 hours now. I was talking to the Fidelity trading desk last week, and they said, at least there is 4 hours, not just 2 hours. It used to only be 1 hour after the market. From 4 to 5 you could trade. And now it's 4 to 8 p.m. So you can do post-market trading for a long time. I would put on these trades right after the close, like 4:15 or something. But catching falling knives is usually a bad idea. A gap continuation, I see no reason to buy this, except the fact that I'm a range trader. I'm a directional volatility trader. Obviously, it's still in a short direction, but if something dropped from 45 to 24, canopy growth may be ready for a turnaround. Probably not soon, though, maybe late September. So I'll let it go a point or two against me, and that's it. We did have a hammer in Kronos, so buying above the high of the hammer would make sense. And again, look at the range, 18 down to 11. That's important. So Cron, CGC, and I also bought me a little Tilray. TLRY is my other favorite pot stock. And down at 26, it was double that just not too long ago. Now it's down at 26. This is more likely to go down to 10 or 15 than it is to run back up to 40. But hey, one thing you can do in extreme sell-off markets when things look like they are overdone or overbaked a little bit, a little marijuana humor there. When it looks like it's been baked down, this is more likely to go to 5 than it is to bounce. But if you do see a bullish hammer or a bullish engulfing, or we recover previous resistance area, the upside potential is really big. And that's important when you're kind of like a quick bottom fishing lesson there, or another one that I'm in, just 100 shares, is the Dust ETF. If it looks like it's sold off and you got a lot of institutional buying, then there may be some good upside potential. So those are the kind of charts that I like to cover for everybody. And of course, directional volatility is outstanding as well. If you're day trading and looking for good charts, SQQQ was really good yesterday, right? It went from, again, my whole number strategy is to buy above whole numbers and sell. I'll frequently sell right under, even if I leave a little money on the table. You may have seen my stocks and commodities article where Twitter was an example chart where I covered you buy right above a whole number, like 20 cents above the whole number, and then you sell right below the nearest whole number is your exit target. So I'm happy to buy 33.20, sell 33.80 all day long. And you can't do that as easily with the cheap stocks under $10 because they tend to not be very consistent. They tend to be choppy. They get circuit breaker halts. The low volume ones are easily front run or manipulated by dishonest young chat room guys under 40. So stop the madness. There's got to be a better way. So if you're day trading, I like charts like this. I was buying TVIX. I think I got in at the 60. Anyway, but I issued the long first alert at 17 and a quarter. Again, selling right under the 19, buying right over 18, or buying right over the 17, selling right under the 18. Trading within 1-point ranges for intraday is a really good strategy. Trading within 10-point ranges is a good idea for swing trades, right? So let's say if you buy over 20, let's say you buy 22 because it's above the high. Not a trade recommendation, but that's what I'm going to do. I'm already in, but I'm going to scale in over the 22. Where would the exit, I got to wrap up now, gang, but where would the exit target be on this? If we buy right above an increment of 10 and we sell right under the next increment of 10, if I buy right over 22, where would my exit target be? A hint, it's right near that 200 SMA, which is another reason to tighten up a trailing stop, like a logarithmic curve as it approaches a major institutional resistance area. Where would your exit target be? Let's say you buy 22 and a half. Where are you going to tighten up a stop once it hits what price point? Pardon me, I'll only get a little coffee there. And a really big turnout. Thanks to all of you. Right under 30, right. 29.30, the 30, 29.50. Exactly right. Yeah, Mira got it right on the nose. I wish all my traders were as smart as Mira. She's learned everything, and every time I ask a question, she always gets it right. So I wish everybody was that smart, but or I should say paid that much attention and became that knowledgeable. But yeah, that's exactly right. Right under the 30. So right near 29, 29 and a half, that would be best case exit target. So the cycle of the trade would be within that window. Now rebuy, now if it keeps skyrocketing up, we don't sell it. We just tighten up a trailing stop. But some of my biggest real money winning trades in this and other instruments have come from tightening up, having several positions that scale in, and then tightening up a trailing stop as it gets to a key resistance area. That way I walk out with maximum profit, and to avoid the FOMO, the fear of missing out, I can always rebuy a new high above the next resistance area, which in this case would be somewhere north of 3150, because that's right above the 200 SMA. So that would be cycle one, the breakout trend in here. Cycle two would be here, and exit target would be right under the 40. So as you're developing an intelligent way to trade, I hope that I can give you some coaching and some ideas. I've got to run. I've got swing scans coming up. We cover charts like this and small cap scans. We cover charts that have big directional volatility. Like, where's a good one? Like this in my swing scans event, which is coming up in a few minutes. Again, we buy right above decade values. We sell right under the nearest decade values. That's an exit target. Rebuy would be up at new highs. So anyways, best wishes for success. Have a relaxing Labor Day weekend. Look forward to working with all of you. Do be sure to join 3winningmonths.com, the number 3winningmonths.com. My live room at Trading the Open. It'll take you over there. And I want to wish you the best. So let's go get them. Remember, hopefully I packed a lot of good tips into this. I know runs a lot of information. A relatively short webinar. Things like looking for defensive plays in gold if it continues, and our VIX and other inverse ETFs that the market sells. That's what to trade. Number two is also be aware of false breakouts that abound in our current market. Expect that any breakout is a bull trap, like we've seen so often. That's been like 80%. You get these gaps up in the S&P, and then it crashes on the open. Or small caps, same thing. You see gaps up that fade. So it's not a gap and go or gap continuation market right now. It's much more a sell the gaps. If you're overnight long in them, take the money and run, because that's going to be it. Instead, you want to look for big pivots off of major support levels or trading the inverses. And that's our session for today. Thank you so much for being here. I look forward to working with all of you. I hope this has given you all some good food for thought. And trade smart. Trade wide, not deep. And again, I apologize I can't answer all the questions Jurgen's saying he's cooking coffee now. Okay, I use a coffee maker, but hey, Walter. You're right, Mary. Yeah, the hammer is twice the shadow of the whole body. Hey, Charles. My amazing cursor is custom coded, so I think that's about it. Swing scans in about 2 minutes, so I got to run. Hey, fine weekend to you too. Appreciate it, man. Anyway, hopefully adding good value to everybody and continuing to make progress in our trades. If I were to go back in time 20 years ago, when I first started trading or day trading back in 99, actually it was earlier than that, but 99 is when I started the company, do a lot more position sizing and start off your trades much smaller and be more diverse. Don't just try and make big trades and say, I think one of the talking heads called it a statement trade, like, I'm going to do 1,000 shares because I know I'm right. And after you lose a lot of money trying that, you realize, let's think twice, let's think carefully. Instead of 1,000 shares, let's try 100 shares. And if it proves it right, then I add more, okay? And if it proves me wrong, it doesn't cost me much. Have the cost of being wrong as small as feasible, and that buys you a lot of chances of getting it right, okay? I mean, I'm a guy who traded over 7,000 real money trades this year with P&L proof. 7,600 as of this morning. I screen capped this at 8:20 East Coast time. But I did 7,633 trades this year alone in my Fidelity account. And success as a trader comes from, you don't have to be that active as a trader. I do this full time. That's what I do for a living. But trade more than less and trade small size. It's like it gives you a lot of shots at the market. Now, you don't want to spray and pray. You want to only trade when you've got A+ rockstar charts, or you've got a clear advantage based on your technical expertise and ability to read the tape and read the patterns correctly, and then go for it. But do play more often is my encouragement, with smaller size and tighter stops. All right, well, I'm out. You guys take care. Thanks for being here.